Most people think tax planning stops once they stop working. In reality, though, some of the most important tax planning decisions we make happen in the years right after retirement, but before those required minimum distributions begin. Welcome to the Wealth in Transition Report, everyone. I'm Mike DePaul, a private wealth advisor with Newport Wealth Advisors here in Southern California. Okay, so here's what we often see. Someone retires in their early 60s. Maybe they just sold a business, stepped away from their career, or simply decided to slow down a little bit. Their income drops significantly. Let's say they go from earning $400,000 a year down to maybe $80,000 or $100,000. And for a few years, everything feels pretty straightforward. But during that window, after retirement and before RMDs begin, something important is happening. They're temporarily in a much lower tax bracket than they've been in for years. Now let's fast forward a bit. At age 73, those required minimum distributions begin. We've done a couple videos on that, so go back and check those out. Anyway, let's say they've accumulated a $3 million IRA. At that point, they're forced to start taking income out of that account every year. And guess what? Those distributions are fully taxable. And one of the more surprising things I've learned over my 20-year career is how much high net worth retirees actually dislike their RMDs. No one really talks about that because on paper, it sounds like income. But if you sold a business, you have stock options or a pension, it's often income you may not actually need. And it's being forced out of your IRA, fully taxable, and often at a time when you have less flexibility to manage it. So what we often see is that income jumps again. Now, instead of being in that lower tax bracket they had in those early retirement years, they're right back into higher tax brackets, whether they need that income or not. And that's where the missed opportunity shows up. Because in those earlier years, when income was lower, there was a window to be more intentional. For example, instead of sitting at $100,000 of income, maybe you choose to recognize additional income intentionally, maybe converting $100,000, $200,000, even $300,000 per year from an IRA to a Roth IRA over time. And by doing that, you're choosing to pay taxes at a lower rate now instead of being forced to take them later at a much higher rate. And over time, that can make a meaningful difference, not just in your own retirement, but how those assets are ultimately passed to your kids. Because as we've talked about in previous videos, those large IRA balances don't just disappear. Eventually, they become taxable income, either for you or for them. So the question isn't just, when do I retire? It's, what am I doing in the years right after retirement, but before my RMDs begin? Because what we often see is that those are some of the most valuable planning years, and they're often some of the most overlooked. And remember, in higher level planning situations, the objective isn't to add complexity. In fact, it's the exact opposite, to simplify through clarity and alignment. Hey, this has been the Wealth in Transition Report. I'm Mike DePaul. Thank you so much for watching.